how do you know when to sell a stock? I'm getting so many questions from people who are like, dude, I'm down X 80% or 90% on this stock. What do I do? Oh my gosh, what do I do? And also on the flip side, I like regularly get comments in my comments section when people making fun of me for selling. But here is an example. Check it out. December 24th of 2020, Peloton stock hit about 160. And in this video, which only got 650 views because nobody likes to watch videos about Peloton, I said this.
But I think if you are heavily invested in Peloton, it could be a good time to take some profit or to ease out of your position.
And then I also said this.
You're holding on to Peloton, please take some profit. It's probably a good idea to take some profit. I would take some profit.
And I see a really interesting dynamic because when I look at everybody's heroes like Warren Buffett or Peter Lynch when it comes to investing, the guys who make 30% every year for like 30 years, which nobody else does pretty much ever, as far as I know, they talk about selling stocks. But for some reason, there's this culture that's been forming on the internet and on YouTube and on Wall Street Bets and Reddit and stuff like that, where a lot of people are like, selling is stupid. Why are you selling? You're so stupid. Oh my gosh, kind of thing. But check it out. Look what's happened with Peloton now. We just got the biggest daily gain ever in Peloton history, up 25%, and now we're at $37. So if you sold when I told you to sell at 160, that would have saved you $130 per share loss on the way down. And, whether Peloton is a good deal right now is up for debate. I think there's a lot to be excited about with the new CEO and with them, cutting a bunch of their staff. And also, there's murmurings of an acquisition on the horizon. Don't get me wrong, I'm not buying Peloton. And I don't think Apple would buy them either. That's kind of a whole other topic. Let me know if you guys want to talk about that more, or do a live stream or another video or whatever. But the idea that selling equals stupid or selling equals weak, buying diamond hands is the cool way to do it, to me is foolish. And actually, when I've made the most money on stocks is when, for example, Tesla, I bought in at $100 pre-split. Then I was selling out at, sometimes $1,200, $1,300, $1,400 post-split is like massive gains. And now it's back down to like $800 or $900. There's a big variation going on there. And for me, you guys know I've been going through this metamorphosis. I've been trying to figure out the best way for me to be investing. And I know for a lot of people, they don't have the time to look at stocks every day. They don't have the time or the interest even to be looking at the news every day. And for most of those types of people, it's really a good recommendation. Just say, buy the S&P 500, X dollars per month for the rest of your life, and you'll probably turn out pretty good. And you might need to switch to being one of those people if you find that you're just getting wrecked and stressed out and aggravated by markets that are downturning hard like what we're seeing right now, especially in small caps. And so you're probably asking, how do I know when to sell? Taking a look at Warren Buffett, basically he says there are two different times. There are two ways you can know when to sell. Number one is if you find a really good opportunity, and probably you're already invested in really good opportunities, but if you find something that's an even better opportunity, you might need to sell out. It might just end up being something like, number one, I found a screaming deal. Like, you have to be stupid not to buy this thing. And yeah, I'm invested in a bunch of other really good deals, but I need to take a little bit of money from some of those right now and put it in this one because it's such a screaming deal. And the other time Warren Buffett talks about selling his shares, is when either the fundamentals of the company or the fundamentals of the market that company is in have started to change. And so an example of that, going back to Peloton here, this is zoomed in on, I believe, the 1 week chart. We've seen they've had a really good week. The fundamentals, the reason this company was blowing up in the first place was primarily because of work from home. There were a lot more people starting to buy these things. You couldn't go to the gym. It wasn't like, really even culturally appropriate to try and go to the gym. And so people were just buying these things and starting to work from home. And a lot of people, for some reason, thought that was something that could sustain and keep going for a very, very long time, even after communities started to open up again. And when that foundational truth starts to change, like it has in this last year, this is the 1 year chart, you start to see, the situation change a lot for Peloton. Now, zooming in a little bit again on the company, like I mentioned a minute ago, new CEO coming in, they just announced. Earnings for last quarter weren't good, but everybody was kind of expecting that. And now they're slashing 2,800 jobs from their company, which is going to lean them out, reduce expenses. This is setting them up for a leaner, more structured, more focused organization, which hopefully will become more profitable. I think they're going to start leaning in more to the subscription services, which have kind of always been their strong point. And so with the stock that you're looking at, the first point you need to consider, on this channel, we've been talking a lot about stocks like Skills or Desktop Metal, which for a lot of you guys are down 60, 70, 80, 90%. Please consider the fact that the lower the price goes, the less risk remains in the future. The less possible risk can remain in the future. If you're already down 90%, there's only 10% more that you can lose. That's a weird way of thinking about it, especially if you're in a rush to hurry up and get your money into another option, or you're just getting irrational and you're kind of like, I need to salvage that last 10%. But the fact is that going down another 90% from here hurts way less than what you've already been through. You've already been through the hardest part. You might as well just ride it out if your underlying investment thesis for the company still remains. And I'll be making another video on Skills here coming up soon, but with Desktop Metal, which I just made a video on last week, it totally hasn't changed. And so it's like a screaming deal, in my opinion, right now for the future, for the potential that it has. And so you don't even need to look at the stock price right now. Now, number two, on the flip side, if you've already ridden a stock up high, how do you know when to sell? You might have bought Tesla at $100 pre-split, and then after it's split, you might have sold at $600 or $800 and been like, oh my gosh, I missed out on that extra $400 per share, which I now have four of instead of one. How do you know when that's going to peak? And yeah, the Peloton example I gave here earlier made me look like a really good timer of the market, but that's not the case. It's more just like, it's more about, have I already made a decent return on this stock? And if so, that's okay to take, profits on. Actually, Peter Lynch talks a lot about that. He is very comfortable to just say, hey, this stock's gone up a good amount and some of its competitors are still undervalued, so I'm just going to cycle my money over there. He's also very clear and open about the fact that there have been times when he wrote a stock and it went down to zero, as well as on the flip side, riding a stock up and seeing some good gains, seeing 20, 30%, and then selling out, and only for that stock to keep going up thousands of percent after he let go of it. The lesson I've taken away from that is dollar cost in and dollar cost out. And it always kind of comes back to this. If you're always buying in, once you see that cumulative profits start to go higher and higher and higher, then you can, and this is what I did with AMD, sell out like, whoa, it's $165 now. I bought in at 75. I'm like, okay, maybe I'll sell 5 shares here. The next day, 163. Okay, maybe I'll sell 5 shares here. And that way, if it drops back down, which it has, it's now like 120, 125. I got like maximum profit, but I was selling 165, 160, 155, 140 because I was just selling out small portions of it. And now we're at a point where it's like, maybe we've reached the bottom. Maybe we're at 120, 125, and it's not really going to go much lower than this. But I feel like my thesis on the company when it was $75 was like, this is insanely cheap. This is way too cheap. And then I did like a huge flurry of videos on it. Check it out up here. But basically, it's played out and I've made my money with that. And now I have a bunch of free stocks of AMD that I can comfortably ride forever. Even if it goes back down to $75, these stocks have already paid for themselves with my profits. Plus, I get to keep all that profit on top of that. So what do you guys think? I'm interested to hear your thoughts. And I know there are a lot of diamond handers for life who only ever buy stocks. And I want to learn more from you guys about why you think that's the best way to do it. This is just, me thinking out loud, sharing about some of the ways that I've been evolving, some of the ways that I've been changing and adapting to become hopefully a better Trey, hopefully a better investor, and hopefully somebody who can impact the world in my community more effectively going forward. Love you guys. Looking forward to talking to you in the comments section. Stay generous.